I appreciate that, Holly, and also thank you for that introduction, Billy. It's a pleasure to be back with all the folks at Brown Edwards, even if it is just virtually. I enjoyed the time I was with y'all last time, actually in person, which now seems like forever ago. But just, today, we'll just take the, next, couple moments here just to share a little bit about where do we see the market going? What are the things that we can prepare for and be thinking about so that we're positioning our organizations to be successful, no matter sort of what comes down the pike, if you will. And so I'm going to just kind of go through some of those, kind of say, here's what our observations are, here's how we're thinking about it, but also, obviously, hopefully have a couple things that you can take away that you can say, okay, well, here's things I can actually do. In my own organization, I can be watching on a regular basis to help me make heads or tails where things are going and know when I might need to move faster or when maybe thinking of doing something a little bit different. So as we kind of run into this, I always kind of like to start off with, hey, at the end of the day, what are the things you ought to take away? And maybe it's just spending too much time at church and the preacher always having that 3-point sermons, kind of taking on some of that myself here. But I do think there's sort of 3 big things to be thinking about, particularly, kind of everything we've kind of come out of from 2020, but also as we think about, okay, well, this transition period of 2021 and what 2022 and beyond might look like. And I think one of the first things is really comes to a question I feel like I get more than anything from folks when they're talking about, what we went through over the last, say 18 months and where things are, and saying really, hey, it felt like it was really good. We got these supply chain issues kind of going on now and some other issues around inflation, et cetera. And the question kind of comes up is, well, is this a real recovery, or, am I not reading the tea leaves right here? And I think that question of durability versus fragility from a sort of an economic perspective is a really good one. And so I really don't know how to answer that question. And you may say, well, that doesn't help me out a lot. But what I mean by that is, things are happening all the time. I mean, there's this saying that, things that have never happened before happen all the time. And so more of it's like, well, what do I do to watch and to say, well, what does this give me some indication? Meaning, what are those red flags or the things that I need to be thinking of that will help me give that sense? Now, personally, I'm kind of optimistic about the market, and I'll go into some of those details, but I do think there are risk factors that are real that we need to be watching. And again, I'll share some of those with you. The second one here, and it may be something I've actually been shared with y'all before, some of you on the webinar here probably heard me talk about, and I hate to sound like a broken record around this thing, but this idea that bulls and bear markets are always, present, no matter what the economy is. So even if this is a durable or even a fragile economy, this concept that there's always going to be winners and losers and opportunities no matter what, that's an important one. And I kind of harp on it a little bit because it's sort of like the old stock market one. You buy low and you sell high, and they say it over and over again because people tend to either act the opposite way. But I think this is an important one to really keep in mind, because again, even if things are great, there's going to be some markets that are down, and even when things are bad, there's things that are going to be up. And the question is for you is, in your organizations is, well, which one of these might be a good potential, fit for my organization? And if you can't even go back to the past recession, I'm talking about the Great Recession. And for the construction industry, that was about a 5-year period from a peak in 2006 to a low in 2011. Over that 5-year period, total construction declined by roughly 40%. So it was a big decline over a relatively long period of time. But of the 19 segments, and segments are a type of construction. So, single family homes is a segment, healthcare is a segment, power is a segment, you name it, all these different types of construction. There's 19 of these that we track. They are the same that the census covers. But about half of those grew during that period, and about half of them declined. And on the extremes, you had single family homes that were down roughly 80% over that 5-year period. I mean, that's about as much as a market going away as I've ever seen in my career at FMI. And at the same time, you had power that grew by over 90% during that time. Now, I know we're talking apples and dump trucks, but the point being that there's always going to be some aspects of the construction industry that are, increasing while others in decline. That's why when people ask me, hey, when's the next recession? I always say, well, that's now, because there's always some markets that are down. And people say, well, when's the next recovery? Well, it's now, because there's always some that are going up. It's just a matter of being able to figure out which of those are, how they kind of run either counter-cyclically to each other, and all those things that kind of go into it. And so that's a big thing to remember. Now, I will also say that when you're evaluating, where, hey, this might be growing, when, maybe some of the work that I'm pursuing is in decline, there's an equation I think you got to really think of, and that's this idea of opportunity and fit. I mean, just because something offers, relatively significant opportunity in terms of either size of the market, growth projections, whatever, doesn't necessarily mean it's a good fit with our organization. I mean, culturally, the things that make us who we are, our strengths, our weaknesses, our resources, all those types of things that would be required to potentially be successful in that particular segment. And I think too many firms, oftentimes when they're looking at diversification and start pursuing new things, they kind of get caught in that shiny, object syndrome, where it looks good and we go after it, and we'll find out later on it was just a big bug zapper, and we hit it, and it just was not a fit. So I think it's really important that in any of that evaluation, that fit is just as much an important part of that equation of diversification as anything else. And then the last thing here, I call it bigger, faster, better, but really what it is, how do things change or evolve in how design and construction services are procured, how service providers are selected, but what are the things that are changing from sort of an environmental perspective? I don't mean environmental like green and stuff. I mean the sort of the business environment of construction that are really starting to determine who's in the driver's seat, who's got that competitive advantage. And so we'll go through some of these things as well. But I think those three things, if you keep these things in mind, I think will serve you really well as you're kind of planning out the next, say 2 to 3 years, this idea of what do I need to watch to see where the economy is? Because as an industry, we follow it, right? So that early read is going to give us a sense and give me some time to actually prepare. This idea that, hey, there's always going to be opportunities. So how do I kind of distinguish those opportunities? And then last, that fit and knowing what's going to really contribute to competitive advantage. So Holly, let me pause here. I know we wanted to do one of those poll questions, so I'll let you go ahead and launch that.
Okay, so I've launched the poll question. You should see the screen up. If you do not see that, you may have a pop-up blocker on. And so if you do have a pop-up and you're not seeing the blue screen, just note that in your question, and I'll take that down for your attendance. But you should be able to click on the little bubble, and if you do have any issues, just send me a question. And leave it up for just a few more seconds. Okay, I'm going to go ahead and close it. All right, thanks, Jay.
All right, so we'll just kind of push forward here. So I was saying earlier, this question about durability versus fragility. So what are some of the things I can look at? Well, there's a whole bunch of economic indicators out there that you can look at. At FMI, we track over 400 different economic indicators that go into our forecasting. And I would not recommend you do that because it will really tire you out. And plus, it makes life difficult. And some of these we're looking at very general in terms of it's just about the overall economy. So things like gross domestic product. We might look at things like, employment and other things. Some of them may be specific to the industries that we're looking at. So if we're looking at, say, educational construction, we're looking at what's going on from an enrollment perspective. If we're looking at highway and street, we might be saying what's going on from federal funding and bonding and all those types of things. But there's one that I think is one of my favorites, and I think that it's a really good one that almost anybody can track, because one, it comes out frequently, comes out every single month. It's free, which I really like. And it also makes my life easy because it's looking at 85 different economic indicators, and it's distilling it down to sort of one number that I can kind of start to get a sense of, is this good, bad, or indifferent? And that's the Chicago Fed National Activity Index. Again, it comes out monthly. You can get it for free on the Chicago Fed's the Chicago Fed's website, excuse me. But what I like about it, like I said, is it's taking all these other indicators and really putting down to one number. And so I've got two things here I'm showing you. One is just, the monthly sort of diffusion index, which is the bars here. And while that's helpful, it can be too, variable month to month. And so I like the moving average, or the 3-month moving average, which is the dotted line, because it kind of takes a little bit of that variability out, gives me more of a kind of a longer term view. But the main thing you need to know is that anytime that number, which the most recent one came out in the end of September, or excuse me, end of September, which was in August 21st here. Actually, I think I may have a more up-to-date number I should include in here. But regardless, as long as it's over a negative 0.7, what that is suggesting, or what that means, and again, that's on that dotted line or that 3-month moving average, is that the U.S. economy is projected to grow at a rate faster than the historical average. So if the historical average has been, let's just say 3%, for example, as long as it's above negative 0.7, that sort of blue line, then we're actually in more of an expansion mode from an economy standpoint. Now, another thing I like about this index is it correlates really strong to future GDP. Now, GDP itself is not really a good indicator because it's backwards looking. It only comes out once a quarter. It doesn't give you a whole lot of heads up, whereas I think the Chicago Fed National Activity Index does. I mean, you can see where, it was already really starting to decline, not in huge numbers. It wasn't below that 0.7, even back in January and February. So kind of starting to give me some indication that, hey, I should really start paying attention. And then, really went below that negative 0.7 line in March. And if you think about it, things really didn't start shutting down until later on, say, April, May, even into the second quarter, where we really felt the biggest shock. But you can see this, where it bounced back up again. So the most recent one that I have on here again was August, but September is very similar. It's still in that positive territory, which makes me feel a little optimistic. If it was negative, even if it was still above that negative 0.7 line, I'd be a little bit kind of concerned, but it's kind of holding steady. The demand is still there. So this is one of those things, like I said, I would recommend looking at. Now, this tells you nothing about construction, or nothing directly about construction, but it does give us a sense of the overall economy, which obviously we're dependent on in many ways. So again, here's one reason to be optimistic. The second thing that I would have you look at and be thinking of on a regular basis in your organization is, okay, well, what about, things that are industry specific, beyond just a forecast, but what are some of the things I can go look at that gives me a sense of where things might be, from my peers? So there's 3 that I like to look at. The first one is the Architectural Billings Index from AIA. Why? Because, well, the designers and the architects are on the front end. They kind of know what's coming. And so it gives me a good sense if I'm on the contracting side, okay, what might be following that. And anything over a 50 suggests that the market is in expansion mode. And in September, it registered as the latest one, a 56.6. So it's in that positive category. And in fact, it's higher than it was actually in August, where it was 55.6. So that gives me a sense. I mean, yeah, would I love it to be 100? Of course. But I will take anything over 50 over something that is below 50. The second one I look at is the non-residential construction index that FMI produces. Now, this is a broad-based index that we do, very similar to what AIA is doing, but this is now contractor specific. And it's hundreds of contractors, both CMs, GCs, trade contractors, all across the country, measuring sort of the same thing that the AIA is measuring, but this time, again, like from a construction standpoint. So again, anything over over 50, excuse me, means that we're saying that the market is in expansion. So the latest one, which is, we do this one on a quarterly basis, not a monthly basis, for Q4 2021. So the most latest one is at a 53.8. So it's in positive territory, but it's down from where we were last quarter, where it was 59.7. When we ask people why, a lot of it gets back to some of the supply constraints. It is not necessarily a demand issue. It is more purely from the ability to deliver some of the work. And then the last one I'll look at is the Construction Industry Roundtable, or CIRT Sentiment Index. And it's kind of similar. It's not a pure, over 50, below 50, but it is a 0 to 100 scale. The difference in CIRT and this sentiment index between the AIA and the FMI is, now I'm getting a little more specific, meaning that CIRT, if you're not familiar with them, really represents sort of the largest design firms, the largest contractors in the country. And they were at a 74.9 this quarter, is down a little bit from where it was last quarter at 79.7. But to put this into perspective, that 79.7 was the highest rating it had had in 5 years. So you think of everything we kind of went over the last 5 years, even take 2020 out of the picture, this is the highest rating in terms of goodwill about where the industry is headed that we've seen. And the 74.9 is the second highest reading. So these are sort of astronomical numbers, if you will, from a sentiment index. So I think that's important, but I think there's also what kind of peel back from that might give me some indication of things. Well, one thing it might say is that, well, is the market shifting towards more of the larger work, or the type of work that favors the largest design firms, the largest contractors? I think those are the kind of questions that we need to be asking ourselves. Well, why would they be so positive when AIA and the FMI, NRCI, they're positive, but they sure aren't, these astronomical levels. They're like, we feel good, but maybe we're not, totally good. We're just kind of maybe a little bit wary. So I think that's one of those things to be thinking about. But again, overall picture looks actually pretty good. That's why I kind of remain optimistic with what I kind of consider to be for the next couple of years. So how does this translate to actual construction spending? So this is looking at the U.S. construction spend across all segments. So this is single family homes to nuclear power plants and everything in between, and billions of dollars. And the reason I like to look at a 25-year history is I like to get some kind of sense of sort of, okay, where have we been? What's kind of been the rhythm and the cycle that we've seen? And so you can see where that 40% decline was I was talking about from 2006 to 2011. And ever since then, we've had, pretty good long run all the way up to 2020. And even with everything that went on last year, it was still a positive year in 2020. We ended the year up about 1-2%. And we look to be kind of carrying forward, going forward. This has actually broken a little bit of the cycles that we've seen in the past, which was really, that, hey, when the industry, or excuse me, when the economy is down, our industry typically follows it, but kind of lags it by about a year to 2 years. And then it takes about twice as long for it to recover. And in fact, we kind of continue to see kind of really good growth over the next couple of years based on our fourth quarter forecast. Now, one thing that I would kind of bring attention to on here, though, is what are some of the similarities? Have we seen this picture before? And so if you look at this and you say, okay, well, gosh, 2021 through 2025 shares some similarities to what we saw from 2001 to 2005. We had a shock to the system last year, but it wasn't really financially originating, right? So it wasn't like it was what we said in 2005, 2006, with the subprime and everything else kind of went on that kind of brought about that kind of systemic problem from a banking perspective. In 2001, we had 9/11. We had sort of this outside of the economy event. We had COVID, a little bit outside the economy event. Not that those things didn't end up having an economic impact. They obviously did, but it wasn't something that was something broken in the system that changed it. So if you look at 2001, yeah, it took a while. It was kind of 1%, 5%, but it's kind of single-digit growth for a little while to kind of get over that before we were up, double digits by the end of the 5-year period. kind of the same pattern that we're looking at here, where it's a little bit kind of 3%, 3% kind of that single digit growth before we start to have some of this double digit growth. So I think there are some things that are positive in that regard, saying that, okay, well, just because, we had all this go through, because in my feeling it really originated outside of the economy, that, we could have a better recovery in that sense. So again, another reason to be optimistic. Now, I also understand that, you look at that and say, well, gosh, we had that, double digit growth, and then we were followed by a big downturn. Are you telling me that that's what we are? Do we get to 2025 and then that's the end of the ride and we're down from there? And so I think that's where it comes important to think about patterns and cycles and everything else. And one of the things that I've always appreciated is a comment that was made by Howard Marks. He's one of the founders of Oak Tree Capital, one of the larger private equity firms in the country. And one of the points that he always liked to make was this idea that, no expansion dies of an old age. I mean, there's got to be something that triggers, either a down cycle or an up cycle. And so, one of the things we always, well, I said we have always, but, since I've been in the industry that we talk about, is that construction is a cyclical industry. And when you take all the inflation out, which is what I've done here, so this has all the inflation removed from it, meaning that whatever a dollar bought you in 2012, it bought you the exact same amount in 2025 as it did in 1965. So it's really making it, sort of a apples to apples comparison here. And if you do look historically, yeah, I mean, we kind of see this kind of rhythm or cycle to our industry in terms of, it kind of comes up to a certain level and it kind of comes back down to sort of kind of near where it probably was a little bit before. But there was always a trigger, there was always something that led to it. So, for example, if you look at that first one, talk about 1972. So, industry is in an expansion mode. Then we have the oil crisis, we have the fall of the Bretton Woods systems, and we see that decline. Then we're back up again, and we have another oil shock. We have the Iranian Revolution, back down. Same thing, you get to 1987 with Black Monday. All these different things that you can kind of see that brought it about. And with that inflation removed, it also has helped to see that, if you looked at that prior one, it looks like, well, gosh, construction in the U.S. is well above where we were in 2005. We're well past where we were from a Great Recession or pre-Great Recession period. When we take that inflation into account, we're actually still below that. We're actually probably even closer to that 60-year median than maybe most people would actually expect. But again, the point being, as leaders of your organizations, you need to be thinking about not only that near-term thing, so looking at things like the Chicago Fed National Activity Index, or looking at these different indices, whether it's ABI or the NRCI or the CERT, but it's also thinking strategically about your organization, saying, okay, well, what are some of those big red flags out there that could mark a big change in the trajectory of construction? And if you're watching those things, knowing what would I do? Because if I go back and you look at that subprime mortgage and that big, huge slide from about 2005 to 2011, when I've talked to most people in our industry and asked them, hey, if I could go back in time and I could say, here's what's going to happen, what would you do differently? And I would say that 9 out of 10 of the men and women I've spoken with said, in the end, the decisions we made during that time period were the right decisions. The problem was we didn't make those decisions soon enough. And so again, if you can be looking for some of these things and just giving yourselves that little bit of a head start. You don't need a huge head start, but just enough to kind of say, hey, got a feeling things are kind of moving, maybe changing a different way. That head start, your decisions are probably going to be the right ones. It's just that timing, making them sooner than anything else. So let me pause there. I know, Holly, you've got another poll question you want to ask, so I'll let you run that now.
Okay, I've launched poll question number 2. Again, if you have any issues and you do not see the poll question, just send me a question and let me know, and I'll take that down as your attendance. I'll give it just a few more seconds to get everybody's vote in. Okay, thank you.
All right. So one thing I recognize is that a national forecast has limited value, meaning that nobody's really chasing 100% of everything everywhere. You know, like I said, this includes single family homes and includes nuclear power plants and everything in between. But I will say there, that doesn't mean it has no value. We just gotta be thinking about what does it tell me? And I think it's really apropos to think about it right now, given everything that we've been through from a supply chain perspective. And what I was talking about in terms of bulls and bear markets coexisting at all times. Let me explain. So you think about this in the analogy of the stock market. So I may have investments in certain companies or whatever, and I may look at the Dow, and the Dow is going to tell me, hey, you know, it was up 5%, it was down 3%, you know, whatever. Here's where the Dow is, and here's how it's kind of trended over time. That may not tell me what's going on specifically with, say, if I own 5 different stocks. Doesn't say anything about, you know, whether those went up. They could be going in the opposite direction. Dow could be up, and those things I own might be tanking. It could be the Dow's down, and mine could be soaring. So, but it's still something I want to look at because the Dow is going to give me some indication of the overall market and also how other players or other investors are likely to react. If the market's going down, does that give me some indication that, hey, you know, they're probably gonna be selling a lot, or how that might potentially impact the stocks I do own? Same thing with a forecast. It might give me a sense of kind of where everything's going. Because if you think about from, say, like a supply standpoint, and manufacturers, well, are they thinking about, you know, I grew up in Macon, Georgia. Macon, Georgia could be on fire in terms of growing, and if the rest of the world is in decline, they're not too worried about what's going on in Macon. They're going to start to reduce some of the production. They're not necessarily going to be sending stuff out to where we need things because we're building. So that's what I mean. It kind of gives me a sense of kind of how the overall world might reacting. And if it's also in decline, think about what does that mean potentially from a competitive standpoint. So I think it does have value. Now, at the same time, I think you need to couple that with what's going on locally. Because again, at the end of the day, all construction is local. So here we're just looking at, okay, well, where are all these different states sort of look to be over the next couple of years? So if we kind of look at, say, you know, Kentucky, Tennessee, Virginia, you know, the areas that we're really kind of concerned with or looking at, you know, what we can see is that, you know, there's considerable kind of growth going on. I don't know why I don't have Virginia on here. I apologize. I'll have to add that. But Virginia is in roughly about the 5% increase.
It's down in the right, Jay.
Oh, it is? Oh, I see it. There it
You
is.
got it.
Yeah,
Yep.
okay. I'm glad someone else was paying attention. But I think it's good to look at because then you can start to say, okay, well, you know, if I'm sitting there in Kentucky and we're projected to have about a 6% growth, and folks in Ohio and Indiana, let's just imagine that they look more like South Dakota. Let's say they were in that -2 range. Well, where are they probably going to be looking to go and do some more work? Well, they're probably starting to say, well, Kentucky looks maybe a good place to be. And so this just gives a good sense of kind of where things are. And one of the things you'll notice here is just the disparity in terms of construction activity across the country. And you look at California, you look at Texas, you look at Florida, you know, you're talking about, you know, states where, you know, over 100 billion, close to $200 billion in construction spending if you're looking at California and Texas. Then you go to places, you know, like I live in North Carolina, you know, less than half that at 50 billion. So a sense of just kind of the how that, you know, construction activity score spreads across the country, and it's not necessarily an even spread. I mean, I know you all know that, but kind of giving a sense of how that can really vary and how you kind of can juxtapose, you know, the size of the market versus the growth of the market. Because some people are going to be more interested in growth, and other people are going to be more interested in just the size of the market. You know, in some of those places you might say, well, you know, if I'm looking at a new market, or I'm thinking about a new market, I think the first question you got to ask yourself, well, if I maximize my opportunities where I stand now, meaning if there's more work to be had where I currently am, that's a much less risky venture than trying to go somewhere new just to try to capture growth. Now, that typically can be sometimes a recipe for disaster if you're not looking at it correctly. But I think it's important to kind of know where things might be from a market perspective. Now, this is at a state level, but the thing that I think is more just crazy about this industry, particularly in the time of 25 years that I've been at FMI, it's just this trend that we've seen of greater and greater concentration in fewer and fewer markets. I mean, the first time I kind of looked at this, I almost couldn't believe it, but that 1 in 3 construction dollars, so total construction in the U.S. is roughly about $1.4 trillion. 1 out of every 3 of those dollars are spent in just 12 metro markets. Now, there's roughly 400 metro markets in this country, and 12 of them represent 1/3 of all construction activity. If I add in the next 15, I'm at half the market. Half of construction spending in this country is in less than 30 markets. And so you can kind of see what those look, here's those 12, New York, Los Angeles, Dallas, Houston, Chicago, et cetera, but kind of give me a sense of where those things are. If I went back just 20 years, it wasn't 12 markets that made up 1/3 of construction. It was more like 30 that made up 1/3. So we've just seen more and more of this concentration of activity. And I kind of expected, like probably a lot of people last year with remote working and everything else, that, well, gosh, that might change it. People are going to move out of the cities and they're going to be, elsewhere. And we just haven't seen that trend to the extent that would have an impact on construction. Meaning the people who could move to, say, Santa Fe, New Mexico, or Boise, Idaho, are such a small percentage of the overall workforce. I mean, there's some stat I saw, not the other day, but here recently during all of this, was something about, I think it's around 75% of workers have to be physically present to do their job. So they don't really have the chance to work remotely. They have to be there. And so I kind of expect this trend to continue, where we'll see greater and greater concentration of activity in fewer and fewer markets. And that might even be true, like if we were talking about Kentucky or Tennessee. In Tennessee, we're probably going to see more and more concentrated activity in the Nashville, the Memphis areas than we are seeing it kind of spread across the state. So just one of those things to keep in mind as we're thinking about this is that concentration of activity, but also what's next. What does that mean? So more concentration of competitive pressures, all those different things that go into that. And then you might even want to know even more about your local market. And I just chose to do Kingsport, Bristol, Tennessee, Crystal, Virginia, metropolitan market. It's one of those. And we can do these forecasts on any market that we'd want to. But I thought it was good just to show that you really got to be coming down to this local market. And this is where I get into that kind of bulls and bears. So if I look at the Kingsport, Bristol area, total construction spending, non-residential is a little less than half of total construction. Think of this as all vertical construction that's not multifamily or single family. Over the next couple of years, kind of forecast to grow at about 2% compounded annually. Residential's been hot, but kind of cooling a little bit from a growth standpoint at 3%. And then non-building, which is all my infrastructure related construction, growing at 16%, but significantly lower in terms of overall share of construction. And that's what I meant by that kind of balance between size of market and growth, meaning that growth can be somewhat, I don't want to say illusory, but when it's on a small number, it's easier to have these big growth numbers versus I might say, well, you know what, non-residential is only 2%, but that's a big market that I may want to take advantage of. And then you might even want to go even deeper and actually look at it on the segment level. Now, I have not included single family homes in here because it kind of distorts everything. But this pattern, I wanted to use this, and I know it's Kingsport, but we kind of see this in a lot of markets here, is that over the next 5 years, that a lot of the growth is really in the heavy civil and infrastructure. I mean, you saw that on the prior slide, but this kind of, I think, just gives another wrinkle or another way to look at it. So the way you kind of look at this graph, I mean, it's probably self-explanatory, but just in case, you're looking at, total construction spending in each of these segments, over currently in 2021. And actually, this is millions. That's not billions. I apologize. So if you say like, well, office construction in the Kingsport, Bristol area in 2021 is about $40 million. And then on the vertical, it's telling me what is the forecast growth compounded annually over the next 5 years, 21 through 25. So sewage and waste disposal growing at almost 15% over the next 5 years in this metro area. But size-wise, not a whole lot to write home about. I mean, it's, probably about $15 million. Whereas someone might look at commercial construction, and say, well, gosh, commercial is 0%. It's not really growing. But again, this is where I think you got to really think about all these different factors and say, yeah, it might be flat, but it's at almost $120 million right now in growth. And I don't care how much sewage and waste disposal is growing, it's not going to even sniff the size of the market the commercial is over the next 5 years. But it's one of those things to be thinking about in terms of, okay, well, I was looking for opportunities. What shares some similarities with what I might be doing? And, what's the relative size? What's the growth? And then what are those things that make it a good fit for me? And I think just a couple of these, to be thinking about is, okay, well, why would some of these be, potentially growing, and why some of these might not? Well, some of it obviously is from some of the projections from an infrastructure perspective. And then a lot of it too, just from the standpoint of, okay, well, where can we have big crowds? And, every state's kind of been different, and every metro area has been different in terms of what they've allowed. But a lot of the office, a lot of the, things like commercial, other things, amusement and recreation that require large crowds and gatherings of people, some of those are just taking a while really to get back. Again, we do follow the overall economy. Well, we follow these overall industries as well. So a thing to keep in mind. But I do want to touch on a couple, like you were saying, well, where are the real other growth areas? Meaning, like I'm talking about double-digit growth, like what we're seeing on sewage and waste. Where's sort of the big markets going forward? And so, everybody's ability to participate in these might be very different, but there's really 4 that I think are really, these are set to be strong growth markets over the next couple of years. And in the top left quadrant or left corner, is data centers. And I mean, everybody kind of knows this. But just to put this into perspective, the 5 largest tech firms are spending combined $250 billion and growing annually to build out their cloud infrastructure. So we're talking about, just massive amounts of money. There is no other segment in the U.S., including single family, that's even close to $250 billion. So it's a massive number. Now, that's a global number, but they're just rolling these things out, these hyperscale, these 1 million square feet under roof projects, and there's just no sign of slowing in any of these. What's interesting though is what you can see is in some of the differences in the way they're procured, the way they're delivered. We're starting to see mass timber being used in data centers. The speed, trying to get the delivery to under a year, so opening new opportunities for prefabrication and modularization. But again, one of those super strong markets. If you go over to the right-hand side, that the other top corner there, distribution and warehouse construction. Again, the amount of e-commerce where it's grown to now is about 1 out of every $5 spent is on e-commerce, and that's growing. They think it'll probably reach about 1/3 of all consumer purchases, by the end of the decade. So we just continue to see a massive rollout again of these distribution type facilities. That also includes cold storage. We're seeing just a massive amount of growth in the cold storage market. Some of that's just technology related, but it's because we've opened up the e-commerce chain basically to perishable goods. When we talk to the owners and developers in the cold storage space, they'll tell you this is the absolute golden age that they've seen. So a lot of growth there. In the bottom left-hand quadrant is really more the advanced manufacturing, but I would actually even extend it to manufacturing overall because of what we've seen from a supply chain perspective. It kind of started with pharmaceuticals and bring a lot of that production onshore, but now we talk with, whether it's food and beverage manufacturers, others, and that Kentucky, Tennessee, Virginia area is a hotbed, a lot of manufacturing, there's a lot of interest in manufacturing. We think that reshoring will really come back, but a lot of it's going to take the perspective of this sort of advanced manufacturing, so really kind of complex facilities, a lot of moving parts to it. And then the bottom corner there is really, I've kind of lumped it in as sort of new energy or clean tech. And it's not just renewables. I mean, solar and wind have been growing just dramatically over the last several years. But I think it's also rethinking sort of how power is not only generated, but delivered and used. So whether we're talking about things like district energy projects and microgrids that we would see on campus related type settings or otherwise, you know, even the rollout of EV charging stations, there's some real longevity we see in that market going forward. So again, just a couple, there's plenty others that we could talk about, but I wanted to just mention these four because I think these really will be defining segments of growth in the construction industry over the next couple of years. So just the last part here as we kind of close up and then open up for some questions. I talked about this bigger, faster, better, and I used to think I would like to introduce this as the $6 million man, because I always liked that show when I was a kid, but $6 million doesn't seem like a lot now when we got, you know, $6 trillion in stimulus. It actually sounds like pretty much a good deal that you could get a bionic man for only $6 million. But these are some of those other characteristics I think that are important to keep in mind. Again, we kind of talked a little bit about, hey, what do I need to watch from an economic perspective? You know, what do I need to be thinking about in terms of where are the opportunities, where are those bulls and bears potentially? But now, like, well, what do I need to be thinking about in terms of how I'm going to position my company? What are the things that are really kind of define the way construction is sort of, you know, structured and delivered and those types of things? Well, bigger in the sense of, you know, more mega projects. Mega projects are projects defined as $1 billion or more. And when you look at, you know, the forecast and everything else, and you're saying that total mega project spend as a percent of total construction spending put in place is about 10% last year, and we're saying that might double to about 20% by 2023, and then up to about 25% by the end of the decade. I mean, how many people can participate on those projects? And if that can be 25%, well, all of a sudden I got to take 25% of that forecast off the table if I can't participate on a mega project. But whether I decide to participate in a mega project or not, it's going to have implications because they are just a, you know, giant vacuum from a labor perspective. So if I start to catch wind of some of these projects in my area or where I'm operating, or even cross state lines, because they will pull from long distances, that might be one of those things. Okay, I got to start thinking about what am I going to do from a labor perspective when I start seeing more and more of these types of projects show up. Faster in terms of schedule. If there's anything that I feel that will help define competitive advantage over the next decade, is going to be schedule performance. I mean, over the last decade, we've seen the average project length for projects valued $25 million or more decrease by 13 months. And some of that's productivity, but some of it's just demands. Like I said, you know, whether it's data centers or others, the ability to deliver faster and sooner are going to be things that are going to put more people in the driver's seat or potential opportunity, I think, than anything else. And then last, better. Well, part of that, you know, whether it's because of the size of these projects, the speed by which they want to be delivered to market, that better delivery, you know, trying to think about, you know, hey, alternative delivery methods. I mean, are we at the point where it's really, we shouldn't call design build alternative anymore? Is that really the norm when you think about the percent of construction that's actually represented by design build now? So those three things, thinking through in terms of, okay, well, what about these bigger projects? So I need to be thinking about how do I participate on those? What's required to be successful? What am I going to do from a schedule perspective? If that's going to be one of the things that really defines, you know, competitive advantage. And then if I'm not in sort of these alternative delivery methods, what's necessary to be, you know, able to add that skill set to work in that kind of environment, et cetera, I think are all three things that you really got to be thinking about over the next several years. And then kind of along those same lines, well, again, well, why? Why ultimately would these things matter? When we look at factors influencing, you know, the owner's project delivery method selection, if we did this survey for DBIA back in 2018, you know, the number one or a close number one was the owner goals and objectives, you know, versus it was schedule. Schedule's still high. And then project complexity and innovation was about 29%. I mean, these were the percent of people that selected this as extremely influential in their selection, the owner's selection of the project delivery method. This year, that owner's goals and objectives went up to 60%. That was a 14% increase in project complexity and innovation, like I was showing you, whether it was those data centers, the distribution centers, advanced manufacturing, up 21%. So 50% of people saying that that's, really, really important. So all those things combined start to say, well, if I'm really also trying to think about what's going to help, me be in a better position beyond things like schedule performance and ability to do things, in a bigger, better, faster way, is really being that focus on what is the owner's ultimate objectives. What are they really trying to do from this project, and what can I do to help them achieve those end goals? And so that, plus there's a lot of other things I think that are important we can't cover in just about 45, 50 minutes or so, but other things I think you need to be thinking about would be things like these 10 things. This is a really short article that we wrote just a little while ago. It's only about a paragraph or two each, but just some of the things to be thinking about too as you're kind of planning for the upcoming year and beyond, and what are some of the things just to be thinking about that can have big impact. I think this is a good list to be thinking of. It's by no means exhaustive, but it was kind of a 10 things that we think that a lot of people should be thinking about, because we get a lot of questions about them. And then just the last thing, I would say is that when you think about strategy and you're thinking about, the market and where things are going, I think a lot of times we are thinking about, what's that next big thing? What's the big trend? And I think those things are important. Don't get me wrong. But I'm also really kind of go back and I think about what Jeff Bezos actually said. He's the founder of Amazon. And someone had asked him one time about strategy and thinking about, all the emerging trends and where things were going and how do you catch the next thing, kind of thinking like Apple or even like Amazon or others. And I thought his response was really insightful. He said, when people think about the next 10 years, a lot of people are thinking about, what's going to change, what are those trends, what's different. He says, what people fail to ask is what's not going to change, because I can really build a strategy around those things that are constant. And his point was, well, people are always going to want, better things, more quality, more selection. They're always going to want it cheaper, and they're always going to want it faster. And so those things I can really plan around. So I think it's that balance between you're looking at these forecasts, you're looking at some of these trends, you're thinking about your own business. What are those things that don't change that I can really plan around? But how do I also keep an eye on where things are going and know when those shifts will occur? I really appreciate the time, and Holly, I'll turn it back over to you.